Welcome back to the Real Wealth Solutions podcast. I am Greg Scully again with my co-host Darren Light. Today, we welcome to the podcast our friend, our partner, actually, on one deal, at least a little bit, and fellow investor Mike Taravella. Taravella.
Thank you, Greg and Darren. You guys are really good friends and even better investors. And that's saying a lot because you guys are really good friends.
Nice.
Very nice. Appreciate that. Yeah. So, Mike, would you do the general bio introduction thing that happens at the beginning of every podcast?
I would love to, Greg. So I am currently the asset manager for Rand Partners. We are an investing firm that has about 1,600 units throughout Kentucky, the Southeast, primarily in Knoxville, Tennessee, and Kentucky. And so before that, in a past lifetime, I was a CPA for Ernst & Young and Dan Gilbert. I went to Michigan State, and did that path because I was told it was safe, easy, always need a job. But as we were talking earlier, accounting was not for me, but it was fun just knowing the numbers because the numbers truly tell a story. And so I just knew taking control of my wealth was doing real estate, because obviously when you work a W-2 job, you're trading time for money, and then you kind of always let it fester and take it home. But really just seeing Dan Gilbert, who I worked with at Rock Ventures, a lot of his wealth was not only Quicken Loans, but also buying properties in Detroit. So I was helping, his startups and teaching them how to scale their businesses, but I wasn't doing that with my real estate experience. So I was buying only single families. So then I realized I needed to kind of burn the boats, go do real estate full time. And so joined the Rand team June of 19, and been rocking in Knoxville and, hanging out with you crazy guys, you goofballs, and just doing some real estate. So it's been a really cool journey, and just really excited to help your listeners navigate these waters during these normal times in 2020.
Yeah, and with your experience with asset management, that's going to be the main subject matter we're going to talk about today. Closing a deal might take 3 to 6 months, and then you got to deal with this thing for 5 to 7 years, something like that, depending upon how long you're going to have.
Mm-hmm.
And and Rand is vertically integrated, and for those of you that may not be familiar with that term, their property management is all in-house. So they buy the property, they manage it themselves with their own team. So I think it'd be we don't do that. So it'd be another interesting discussion, kind of talking from both sides of that third party or fully integrated management.
Yeah, I think the vertically integrated definitely adds a piece to it. Obviously, it's a slower build, because when you talk about acquisitions, everyone talks about acquisitions, the AC fees, but then the biggest thing is when you get the keys to the building and you're like, now you have to manage it, right? So obviously, when you have your third party, you can quickly, as long as you're getting acquisitions in, you can scale the investing firm. But when you build in a property management, your perspective changes because you're managing it yourself. So you have to build the infrastructure, the team, and everything around it to really make sure you're getting it operating, right? Because execution is the biggest thing. Because I can underwrite in our underwriting template a 20 IRR, but if we're not executing it, then investors aren't happy. We're not happy. It's just a revolving death spiral, and it just really sucks a lot of time, money, and effort into it. So it's really important to just make sure when you're, a lot of investors ask us, when's the time to scale up and do your own vertically integrated? And so it's just a matter of what is your highest and best use of time, because you might have to scale up and get so many units, but if you don't really love your third party property manager, they're not executing quite how you want to. And to be honest, if you in a time period, we're not doing a ton of deals, so we're really refining the systems and structure. it might be a good time to do it if you have enough units or so.
Mhm.
It never makes sense in the beginning, because as the investing firm, you're always thinking of the next deal, the next deal, the next deal, the next fee. But that property management company, when you slowly build it, it's such a powerful force that allows you to scale and grow with much more momentum. And it's hard too, right? You're building two businesses simultaneously. And like we were talking before, accounting and all these other sexy topics that everyone, like property management is your defense to your acquisitions of being offense. So it just takes a lot of time to build out, but if you do it correctly, it can be a powerful force.
Yeah, that's a great point. I haven't really thought of that before. Being able to use third-party management just while you scale or get to the point where you get to that tipping point of where hiring an employee and a maintenance tech or something makes sense. That could be a great advantage to grow first and then integrate later. Because the only thing, if you do it right, the only thing that's going to happen is you're just going to help your returns.
Yeah, and experience, right? Because then
Yeah.
you're seeing all the bills come through. You're
Hmm.
not getting a markup. You're seeing which avenues, and you can truly, if you have a decent enough unit size, all it takes is one person. If you get a back office person who can hybrid, and I mean, obviously you can't shoot for the moon and pay, CEO or top managerial salaries, but I think it's important just to understand. Oh, did we lose him?
We'll edit him out if we have to. You can keep going if you want. That's kind of
Uh,
weird. Oh,
And we're back. I had a technical difficulty, and we're just going to move on like nothing happened. So we were talking
Nothing
about
did happen.
nothing happened. Nothing happened at all. Yeah,
Yeah,
my computer
so
was plugged in and charging, I swear. So we were talking about vertical integration, how using third-party management can help you get to a point where you've scaled enough to bring it in-house. And I thought that was an excellent point. I was going to go down the path of you're involved in property management, but you are not the person showing units. You're not doing lease ups, things like that. So you are what many of us that have third party management are more of the asset manager. So you're getting the data from the property management and are really analyzing it for efficiencies or whatever, correct?
oh yeah, and I
Okay.
think too, I think a lot of I don't like the notion that the asset managers manages the property manager, because it's a collaborative piece, right? I think that's the you managing the property, so it's just over, but it's really collaborative. Like for example, like when doing the budgets, I might think it costs $1,000 to do the flooring for a unit, but really it could be $1,200. So if we're just constantly butting heads, it's not going to really do any good for the property if we're just really seeing or showing that if I put 1,000, it's always 1,200. It'll never work out. So then it's really just kind of okay. If we can't take that number from there, where else can we reduce our costs or increase our income to really make sure we're a very profitable property, right? Because as you know, and the listeners, and increasing the net operating income is what makes the valuation of the property. So whether it's we're increasing rubs a little bit because there was a little more utilities, or charging pet fees or move-in fees, or reducing, I mean, in our property in Lexington, Kentucky, we saved $1 million on expenses, which were bloated dues and subscriptions, a $30,000 billboard on on like a very popular street in Lexington. Uh, so it's just like those collaborative pieces that you really get creative that you wouldn't have thought of, that you don't want to hinder the resident experience, but you want to create an efficient operating business.
Hmm.
you're involved in, I think it's 1,600 plus doors currently with however many properties, 20,
Yep.
I don't know. Is it possible to come up with benchmarks for each expense that you have? Or is it always, I know it's going to be market specific, so therefore it's going to have to be property specific, but so is it just the gamut of, hey, we know we cannot, in Lexington, Kentucky, there's no way we can run a property at 42% expenses. There's just no way. And here's the exact reasons why we know that. maybe we're not going to stop trying, but for now, we're going to revisit this not every week or every month, but maybe semi-annually or maybe annually to see if we can knock it down.
That's like the best part of it being collaborative is that we just did all of our budgets this year, and I literally went line by line through our GLs of what drove that account, right? So, for example, like application fees. If you have a year's worth of experience, we can see how many applications hit per month. Because the previous year, when we took over our property in Lexington, I was conservative and assumed one application for every one move-in. But really, that realistically is probably 3 applications for every one move-in. And it's, advertising. Where are you spending your dollars? Are you doing free Facebook Marketplace? Are you doing apartments.com? And where are those dollars per month? So it really just helps you to drive. And even too, the number of move outs. How many floors are you going to turn? Is it every turn? So you just get granular and saying what drives this account. And this is where my accounting background came in. What drives it? Is it monthly? Is it per move out? What is it? And then just kind of allocate funds to it. And then it's just sitting with your property management team of, hey, I think this is really high. What happened? And we review it monthly, but we tell the property managers it's not like a whipping tool. If it keeps happening, then we're having a bigger question of, hey, are you being able to execute? What's going on? Are you misallocating funds? Like what's going on? But if it's a one-off experience, then it's another, it's okay. It's not ideal, but it's okay. And we'll move forward with it because
what I also like hearing you say that you're alluding to is you're empowering them to run the property. Therefore your asset management is collaborative. And I hadn't really, I know that in my mind. I haven't really heard anyone say that because we do. Even when Greg and I talk to anyone, we're like, oh yeah, asset manager, managing the manager. I guess that's what we've been programmed to think or know.
Every other podcast and book and articles says
correct.
Manage the manager.
Or maybe just explain it to other people. But I like how you've made it collaborative, and it gives me a new, as we are drawing closer to self-management ourselves, not you're there quite yet, but trying to put the pieces in place. I love that. And I also like the analogy you used earlier about your investment and or the property is the offense, your property management is the defense. Being a football junkie, that makes sense to me. So something else I can use in my repertoire later with Dash Mikey T beside it.
And the paradigm I say with our property managers is everyone loves Shark Tank, that $1 billion. And I tell our property managers, you are the CEO of this property. You know every dollar coming in and every expense going out. So if you don't know your numbers, why should we invest with you, right? So it's just important that paradigm, everyone clicks of like, oh, I don't know my numbers, or I don't know this very well. And so that opens the conversation of, hey, how do we, it's not ideal, but if you train someone, they're going to stay longer, they're going to execute and ask better questions. Because my goal too, especially being vertically integrated, is take that property manager and eventually do our, our founder's job, Jake Cinziano, and really make sure that they can execute, right? Because every property manager has their own specific issues and they think the world's ending. But if you take that level up to the area manager, now you're looking at 3 properties or 4 properties or 200 units, we'll say. And it's like, whoa, the paradigm has changed. But they're asking the right questions to scale up because you don't want always a property manager to always be there. You'll find the right few people rowing in the right direction that want to scale up, learn, and be executors. So it's a cool journey to see firsthand.
I don't want to get too far down a rabbit hole, but do you find that you guys, and you mentioned the word training for your property managers, do you find that you've got a great people person, you really, really, really want to hire them, but they're lacking in the financials or the experience, whatnot, but you go ahead and take them on, train them, it's worked out great, and then maybe vice versa. They're really good at numbers, but not so much the other way around. Or I know sometimes you can ask all the questions in the world, they check all the boxes, dot the I's and cross the T's, and when you hire them, a month or 2 down the road, it's like, oh, how did we miss?
If they're generally a culture fit and will have the drive to learn, then I'd say go with it because you'll figure it out together.
Yeah.
And let's be honest, not every property manager is going. A lot of our property managers worked at Ruth Chris and other of these hospitality businesses. So they might not have the numbers experience, but I know I can teach them and the people who thrive in property management know their numbers. They might not get it day one, but it's that aha, it clicks, that knowing your numbers. So if they have a culture fit, can-do attitude, and will work to figure it out, then I'd say move with them and learn together, because that's the only way you're going to kind of evolve and grow as an organization. And you'll know quickly, and, you kind of, when in our organization, you'll see kind of people who are like not in it because just numbers slip, whether it's collections or whatnot, or expenses getting in. But the people who, when they turn on and know the numbers and love the numbers, and you can ask them, hey, how much does this water bill cost? And they're like, boom, usually off the top of the head, those are the people that'll go far in the organization.
And you can incentivize them once they learn the numbers too, to run it.
Yeah,
Hey,
I think,
these
we're
are our
doing a
metrics.
budget. Yeah, we're doing a budget. It's occupancy, and then whether or not they hit within their target of their budget. So it's the incentive pieces there as well.
Okay.
So,
You
coming
agree.
back to, getting to know those numbers, you certainly expect the property manager to know it. Many investors are going to have the third party manager. So you need to know the numbers as an owner as well. So how often are you looking at a single property's reporting? Like weekly? I know I look at stuff. I look at stuff a lot more than weekly. So probably I don't have to, but very minimum, we do a weekly kind of roundtable with another partner, and we look at some KPIs and stuff, and then monthly. Actually, we don't really do a monthly report because we're doing it
No,
weekly.
you do a
We actually
kick-ass
don't
weekly
summarize
report,
it on
and
a
we don't
monthly
have to
thing.
do a monthly report.
I mean, so
because
what are
do
you
it.
looking at? Like, hey, it's
Yeah.
Monday. Mike's awesome apartment complex is
Stop it.
the complex we're going to look at today. What kind of data are you looking at?
Yeah, so we do a weekly pulse document. Uh, it works really great on a weekly basis because generally we're looking at occupancy, delinquency, and then kind of the ancillary, but still kind of moves the needle on the income. So we're generally looking for occupancy, and this is for our specific markets. This isn't everyone, so I want to caveat it with that because this is our number in East Tennessee and some in Kentucky. We generally looking to be at least 95% occupied. So if that number isn't hitting, the next number we're looking at is our marketing. So if it's less than 95% occupied, we want to see 3 guest cards, which are general inquiries on the property, to 1 applicant. Because if our occupancy isn't there, the problem is our marketing is off. So is it apartments.com? Are we doing Facebook Marketplace? Have we pulled back on something? So if the occupancy isn't there, check our marketing. Because if you're getting the guest cards and not the applications, does that mean we're over promising on the ad, but we're not getting, when people actually see it, is it not hitting? And if you're getting the applications and they're not, executing leases, then it might be the property manager level or the customer service. So it looks into our training. So then we're looking at delinquency. So are people paying rent? I think especially with the COVID-19 pandemic, it's been a big piece. Thankfully, our property's been around 94 to 96% economic. So that's been super helpful. And so that is a good track of, we do it weekly. During the pandemic and more parts, we still track it daily just because we want to see cash coming in and any trends. So if any investor asked us, we have a report of how much rent we're collected each day. But generally, I'd say in a more normal instance, we're checking that weekly just to kind of monitor it. And then from there, we're just keeping tabs on how many leases are terminated, because once again, that's the customer service aspect. Also, we're looking at how many apartments we're turning, and we're also looking at how many renewals we did, because we want to see how many people stay in the property. And that's important too, because of customer service, but also think of how many turns you have to do. If you keep someone in there, have a 3% rent bump, you don't have to do floors, you don't have to do paint. That could be $2,000 you just saved on just that aspect, not including trash out and all these other things you might have to do. So we just want to keep tabs on that. And then on monthly basis, if you hit all those things right, the issue would be you overspent on the property, because if you have people in, people are paying. The only other issue you might have is that you're overspending on the property. And so that's where we review our numbers with our budgets to make sure our property managers are hitting those numbers on the expenses, but also just to make sure on a monthly basis where our cash position is.
Oh, okay. So by overspending, you're saying, okay, we fired on all cylinders on the income side. Occupancy is physical and economic, right where we want them to be. Everything else look good. Now let's just see if there's something we can optimize on the expense side.
Yep.
Okay.
And we've had instances where it's our lender didn't escrow a parcel on taxes, so we had to pay a $20,000 tax bill for one parcel. Shit happens, but you kind of look at it and go, okay, well, we couldn't predicted that, but the budgets are perfect because they ask you, why did this happen? How could we have prevented it? And is it recurring? Because if it's a recurring issue, then you kind of have to take the Ray Dalio of looking at the machine vertically and going, where is the problem, right? Is it we're not negotiating hard enough on a particular contract bill? Can we ask for a discount? Are we just flat out overspending? Because we've spent a lot of money on floors on one of our properties, and we had to let the property manager go because we said, don't do it this way, and kept overspending and overspending. And we're fiduciaries, right? So we have to make sure our investor returns are hitting.
Mm-hmm. And then I would add, I'm sure you looked at it, or maybe you mentioned it, but like monthly, we look at future lease expirations to try and get in front of them. You know, sometimes they pile up. You got like 5 or 6 of them happening in a month. And at some point, you got to choose among those if you don't have the funds available just to rehab everything, or you might not even have the labor available to do that to do 5 turns in a month. That's a tall order for most people. So
Yeah.
you just have to strategize a little bit. It's like, hey, these lower earning units, we're going to go ahead and do the full rehab and get whatever the $200 rent bump, and let's try and renew everybody else so that we don't take it in the shorts on the physical and economic occupancy, because everybody left and we never asked them to stay.
Yeah. And I think that's why we've been super proactive. We're generally 90 days prior to expiration. We're getting pulses on that and communications going out. So our property managers know and aware, and that's why we keep tabs on the renewals, just to make sure you have people 1 in, 2 paying, and 3 happy to live there, right? So it's and also too, another thing on a monthly. So on a monthly basis too, we take at the whole portfolio and we look at income, expenses, NOI, and we look at delinquency as a percentage of income. And we also look at our net promoter score. So this is a 2-question survey we ask all of our residents. The first question is, in a scale of 0 to 10, how likely would you refer a friend or colleague to stay at our property? And number 2 is why. So the combination, anything 8, 9, and 10 are promoters. 7 and 8 are the passive, and then anything less is detractor. So our goal is to get a blended average of 75 or greater, which is the equivalent of like an Apple's customer service. So in property management, it sounds like impossible, but we've had a couple of properties hit that mark this year, because it's important, because the customer service is the aspect. I learned this ism from Dan Gilbert. Numbers follow, not lead. So if we're doing all the customer service things right, then the income will come and the expenses will work out. So it's been really cool to kind of see the better months we've had higher net promoter scores, even in the pandemic, than the other months. And it's just looking at that and actually measuring it. It's been really cool to see.
I've got 2 questions. Is the net promoter survey monthly per resident each month?
Yes. Yep.
Okay. And going back to lease renewals or pending lease expirations, possibly renewals, when you're at that 90-day mark and you reach out to them for the first time, at that point, do you go ahead and say, hey, by the way, if you renew your lease with us, do you incentivize them maybe with a month reduce rent to get them, but yet raise their rent like $25 a month? Did you do anything like that to engage them early?
We kind of just lay it out of like, here's what it'd be if you were to be, because the pain point for the resident is if they have to go month to month. So we're preventing that by doing the renewal in a 12-month lease. But also too, it starts a conversation, right? So for us, we have 900 units in Knoxville. Hey, they might have to move across town and stay at a different property. We can give that answer to them. Or they say, hey, we'd love to stay if we had this, which could be a small turn. I've seen, random instances of like a small fix go a long way and they stay another 12 months. So
Okay.
it really just depends, but it's to start the conversation. And that way you keep, residents in, and they might be at a different property, but they're still within the portfolio collecting. So they might be looking for an upgrade or a pool or this and that. So, it's just the biggest thing is you want to start the conversation. And when you provide that clarity for your resident, you just know right off the bat whether they're staying or leaving, and allows you to game plan for the next move and get that unit pre-leased. So it's being proactive and gaining that clarity is just a game changer for your ops piece and your returns.
I guess the goal is just to get an answer from them as quickly as possible. And if you can get it 90 days in advance, that's wonderful. You know whether you're going to have to go ahead and turn that unit, or if you can go ahead and just put a new tenant in without touching it. Or go ahead and, if you did renew their lease at the 90-day mark, I guess it wouldn't start until 90 days are up. It starts over again, right? And then you may or may not bump the rent.
But also too, it starts a conversation because they might feel like they have to move, but you can have them switch properties or even units, right? Like they might just not like this particular unit, but you're starting the conversation and being proactive. And say you have a different apartment down the street that might be a little bit closer to work. They might love you and your organization, but they just are like, dang, this is the only option I thought I had. But you could be there, give the answer, and have them stay at a different property. So I look at it as you're proactively trying to solve the problem, and you're just doing it 90 days before it. Because a lot of times I think we've seen just in property management, and we had Joey Coleman consult us. He goes, how often do you as a property management group, you move them in, you do the survey, like, hey, how's your moving? Great. And then you don't talk to them for another 10 and a half months.
Right.
Everyone's like, just kind of self-reflects like, dang, we did that way too many times. And so Joey Coleman's thing is how to never lose a customer is like you be proactive, create a phenomenal experience. So even on the front end, if they're not happy with something, you're being proactive and finding it out so you can go fix it so that they're a huge fan and never leave. So we just are trying to create a very high customer service, and we're focusing on BC housing. It's not like we're doing the A+ properties. We're doing BC workforce housing to help our residents have that customer experience.
Yeah, that's great.
I'm curious about move-in criteria. How often do you guys look at your move-in criteria? Do you have different criteria for different properties, or do you set something, portfolio wide? And, what levers do you see available to you? I mean, as long as you're not doing anything with the 7 protected classes, you can do stuff with credit score or multiple income of rent, that kind of thing. Just your thoughts on that. That's something that I've very recently seen as brought up in property management, and I haven't heard it talked about a lot. So
yeah, if you have to lower your credit score, generally not good things are happening, or you might, unless you're like 700 and up only, right? But generally that's where the kind of the guest cards come in, is like, how many people are we marketing wrong? But generally no evictions. You have to 3x, make 3x rent. But the biggest, and if someone doesn't have any credit or anything, having co-signers and even deposits, right? It's a risk tolerance. So if you have no credit, no experience, you might have to put a deposit or pay a couple months rent first just to have it prepaid and locked in. Generally, we're 3x rent and no evictions are the biggest things we look at. Because on any other case, even with my single families, I'd post something on Zillow. And then I get a 9-page dissertation of how they got screwed on a Craigslist scam on why they should live there. And it's like, can you take rent? It's like, if you're going to be a pain on the front end, I really don't want to deal with you for 12 months on why you don't pay rent. So it's just important when you're sifting through these resumes, you think, do I want to deal with this person for 12 months, 2 years, etc. Right? I know, and just doing that on the front end, because I did it myself, and it was just dealt with a lot of people. But I think it's just having that system documented of, and that's the biggest thing, even for us, is we're continuing to document the process so that we never have to think of what happens if this happens, right? So then that way we can go to our manual or documentation of, this is why we did this, and here's the results. And we constantly tweak, but generally those are the biggest things.
Do you make any changes to like how length of employment or anything? Part of what this person was talking about was if you are in workforce housing and you have a lot of people in the service industry, and this is very related to COVID, people not paying because a lot of those businesses got into trouble. And their point was maybe, you look for 2 years of stable employment with the same employer rather than 6 months, with the logic that they're probably less likely to lose their job because they are potentially viewed as a more worthy or worthwhile, or those are both the wrong words, a better employee to keep around.
Yeah.
Should things hit the fan for.
I think on the acquisition side, we focus on that more because generally it's who's your resident base. So if you have, I think just on a general investing, if you don't have a diversified employment class, then they're more risky, right? Especially during a pandemic, if they all work at, say your 20-unit complex and they all work at the local restaurant, COVID swings, they don't do takeout, they're done. You have 20 people who can't pay rent. So I think it's just trying to we've really focused in on the acquisition side. I think us being in East Tennessee, we haven't really been too hit with it. But it's kind of case by case, but I think it's just, that's why we get applications on the front end, just to really understand where our residents work, and then just understanding that risk. Because you look at a cap rate and, it's the underlying, here's what it is, like, here's the apples to apples comparison, but you got to look at your market, your sub market, the property, who's staying there, because any one of those things could have like a humongous risk associated with it. Like look at Detroit, like Cleveland, Ohio, or Detroit 0809, it was doing well until the auto industry collapsed. Now look at all those residents, and now it's displaced. And even now, even on like all the Mercadia stuff, it's been picked on. But it's just one of those things you just really need to know your employers, the job sectors, making sure they're diverse, the employment is diverse, and making sure your resident base is diverse as well.
Yeah, I mean, because you're in Orlando, you're like, 2 years ago, we're like, we got this great complex, man. It's 3 blocks.
You throw a rock in Florida.
3 blocks from Disney, Disney.
You throw a rock in Florida.
20,000 people.
Yeah, you throw a rock in Florida, you're like, oh, we'll flip it in a year and make a ton of money. But now you're in a pandemic, or even think of like a year ago. Oh, if I just get a bridge loan into 2020, I can refinance the sweet apartment into 4X. And now it's like the cap markets or the lending froze. Now it's just like a tough product. So it's just important to really just make sure you have as many outs as possible. Because obviously you can't predict a pandemic or anything bad to happen, but you want to have as many different options as an exit as possible.
Mm-hmm. Hey, it's Greg from Real Wealth Solutions. If you'd like to know more about our passive income opportunities, jump onto realwealth.solutions and hit that schedule a call button. We're always happy to talk about our multifamily and flip projects and to answer any questions you may have. Again, that's realwealth.solutions. We look forward to hearing from you. And now, back to the podcast.
As possible.
Can you explain what a guest card is and how you guys use it?
Yeah, so a guest card is a general inquiry on the property. So we have an AI bot that, apartments.com, it's a chat feature. Someone could call in and say, hey, I'm Darren, I'm looking to rent a two-bed apartment. And so our property manager will type it in and see the guest card, create the guest card, Facebook chat as well. So it's a general inquiry on the property, and that's kind of the lead capture, put them in the system and follow up with them and see, did they call, did they text? It's a CRM, customer relations management or client relations management. And so it's just really important just to make sure you're capturing it, because you want to make sure, and we've hit on our property managers to make sure all leads matter. So it's important to just make sure we're getting them in and seeing how we're following up and what was that resonating point. We also have a YouTube page for all of our properties, so that you can see, like, even over the weekend, I was showing my grandma, hey, this is where I live. It's not this exact unit, but here's a walkthrough of the entire unit. So it's just making creative ways to showcase your units and just your portfolio, to help as many residents as possible, especially in the online era. I think with the pandemic, we had to do the virtual leasing, and we even had a concession for whoever took the best walkthrough photo, just so that we're getting as many leads in as possible.
Yeah, and
So
that's well, I was just going to say those are great things. I think people had put that off for whatever reason, but
We did.
now with everybody, yeah, with everybody going online to do everything, and once you have those virtual walkthroughs, as long as you don't make a really significant change to the look of the property, those are evergreen. They
Yep.
cost nothing to duplicate. And you just stick them up online somewhere and direct people towards them.
Yeah, no, exactly.
If-
And,
And then
and
you're
it's
done.
evergreen, right? As long as, like you said, nothing happens. But it's been really cool to see. And even just like, there's like a Google site we did, so that, hey, I'll send you this link and it'll showcase the fees and next steps and everything else. So it was a cool, free, creative way to do it.
I thought I heard you say that possibly statistically that 3 guest cards lead to 1 application, or maybe that was just something you threw out as a
That's just
possible
our
statistic.
that's just our benchmark to make sure our marketing's hitting. As long as if we're not 95% occupied, we want to see 3 guest cards for every 1 applicant.
So does that mean
okay? Because that means people are seeing the property enough, and once they're seeing it enough, they're applying, right? So
does that mean 3 communication attempts from 1 person that then actually filled out an application, or does that mean 3 people?
3 people.
1 applicant. Okay, I understand.
Because if you don't have as many guest cards, if you don't have a lot of guest cards, that means that not enough people are seeing it. And then if enough people are seeing it but not applying, then we're over promising, under delivering, or they didn't resonate with that property manager, or something happened on that aspect of it.
So even if we're not utilizing the chat function as a form of AI or whatever, if we're getting a direct message via
phone
Facebook,
call,
whatnot,
email,
we're considering that a guest call. Okay.
Any general inquiry on the property.
And I would imagine, most of your marketing is a lot of it's subscription based. So you're paying whatever, $225 a month for apartments.com silver package. You can't really lay the gas on that. You're stuck with that. So when you're having an increased marketing, are you hitting those free versions just a little bit harder? You're like, hey, we're going to up the frequency on our Facebook ads, or we're going to do a Craigslist ad refresh every or 3 times a day or something. I mean, what levers are you pulling to try and get that card count?
Yeah, it's been interesting. So in Lexington, we have our property management's dynamic with Facebook Marketplace, and does really well there. Our other property in Louisville, we have the AI bot will bring in 100 guest cards a month, no questions asked. Like even we'll have 1 vacant unit, and it's like so much lead generates towards it. Other places, it's generally an apartments.com gets the job done. But I think it's been pretty interesting to see that even across 1,600 units, the answer is it depends, but generally apartments.com is our baseline. I mean, other properties too, we've done apartment guides, and that gets the job done. But at a baselineapartments.com has been working, and then you can get creative with Facebook Marketplace, I'd say.
How much traffic do you get through your property specific websites?
We're actually, we don't get it. I don't have that number, but us as an organization, we're looking to work with Appfolio to do the websites through there. We felt it's just because instead of having us have a web developer do it, we'd rather just have Appfolio's replicatable system. I'm a big systems person, so why bang our head against the wall 1,000 times when Appfolio's done it for a lot more and bigger clients than us? So we're just using them as a resource to kind of just make it clean, easy, and good to go.
Yeah, and that's
Generally,
something
most of our leads is apartments.com. I think Appfolio is the website that might be a game changer, but I'd say baselineapartments.com.
Because it's snowing now, Middle Tennessee, awesome.
Sorry, I brought the snow back from Michigan.
That's fine. Since we use third-party manager, we actually do some of our own marketing, and we just push it towards their website. So that's a little hack that we've done is, we get Facebook messages sent to Kim,
Every day.
who does that, and then we actually just forward it to our property manager. It's not the best system in the world, but we're like, hey, any traffic that we can create for free and send their way, gonna hurt.
Well, and I think too that just depends on the market, right? So if Facebook Marketplace is the place to go, I've even seen groups do it in due diligence. They'll put kind of like a dummy ad just to see how much lead will generate, and then plus two, then how much you can get in rents day one, right? And just seeing how many guest cards there would be on that one Facebook post. So it's a lot of test and measuring, but the last thing I want your listeners to do is dump Facebook like tons of money in the ads and apartments.com and buying a centerfold or a newspaper ad and like, oh, I did it all, right? It's testing and measuring of what really moves the needle. So like if you're good in Facebook Marketplace, great, but then it goes back to the highest and best use of time, right? If you want to scale, is your best use of time checking Facebook, getting those guest leads? Maybe you have a VA who does it for cheaper. But either way, just kind of developing those scripts and systems so that you can do your highest and best use.
We were talking about COVID a little bit, and so I'll just kind of stick with that because it's just one of my questions. Has anything that has happened through COVID turned into a new policy that it's going to stick around for a while? Just wondering.
Yeah, I think it really hammered in our customer service. So one of the stories we tell is for every person at the property during the toilet paper shortage of 2020, because we get our toilet paper from like an industrial like supplier. So literally we gave everyone a roll of toilet paper and a note saying, hey, during these crappy times, Rand Property Management is a resource for you. So hit us up anytime. We're here to help. I don't think there's like a specific policy or procedure that resonated, but I just think the biggest thing for us is we just really resonated with our investing criteria. So we just were having a lot of headaches with older properties and not as nice areas. So we just really honed in on trying to buy because even too, like you couldn't buy deals. So it's just been really honing in our investing criteria, which I think has really helped us get really granular of what we want, which short term, you're like, man, I'm never going to get a deal. But the Rick Sapio effect of like, if you keep thinking about it, it'll come. And we've had realistically, we've only been close on 2 or 3 deals. But if everything's your target, you're never going to hit anything either. So we just really dialed in on we'll look at 70s, but 1980s and newer assets, they make sense cash flow wise. I mean, we haven't been close on 100 plus unit. We were closer on 50 units, but even then too, we're doing off-market campaigns. So I think it's just getting really granular on what you want as an investor to manage. Because I've seen a lot of investors too of the cost of the only way we could do this a deal is if it's really old, a really bad area, and that's just how you just get beaten. And 0 to 1 is hard, but managing that one to get it stabilized, I mean, take a lot out of you, and you're not going to want to do a second at bat with it. So just get really granular and be very patient, and even connect with other investors and see what their thoughts are.
Okay, right on. So this is another one of my notebook questions. We're just going to hit you with those.
Do it.
So yeah, because you mentioned getting a property stabilized. I mean, there's so many moving parts there. That is a fabulous team effort that goes on to get it there. But once you hit that, 90 to 95% occupied, and you take a breath, and you're like, wow, okay, this thing's kind of running itself a little bit now. With the stabilized property, what do you look for continued opportunities with a stabilized property? What are you paying attention to now that the biggest fires are fully put out?
Yeah, I think maintaining, right? That's always the hardest part. So we're just making sure, is our occupancy stabilized? For us, it's at 95 mark, right? So we've had properties where end of December, it's 98, but then it slips and we're like, hey, what's going on? And so it's just really important just to make sure that level of excellence maintains. And then once assuming it's stabilized and that excellence is still there, whether it's in income and expenses, I think it's important to get creative with it. So one of our properties, it's a 60s assets. The utility bills were always so high. We actually decided in the middle of June of a pandemic to fill in the pool, which we absolutely got destroyed by our residents on the NPSs of like, what are you doing? It's the hottest month of the year. Why are you doing this? But we filled it in, turned into a nice picnic communal area where there's fire pits, those flag pergolas where it's 3 points. And it's a really cool area, which we got roasted on our NPSs for that. But by now in end of November, what's happened is more people are there. Our water bill is drastically lower. So that property became even more profitable and it was stabilized, right? So you really get to take a step back and see, hey, what are we doing? Like, can we add some storage units? Can we really focus on, where are our market rents? What is our competition doing that we can do? And you just really get to kind of get creative with solving residents' problem and making sure that they can, have a better lifestyle, but also you're working on the profitability of the community.
Yeah, I like that. Yeah, because just continue to be creative, because once the obvious is taken care of, that doesn't mean that there's not an opportunity.
Yeah, and that's why we
Yeah.
did the NPS surveys too, because we found people really didn't like the exterior lighting at one of our properties, and they're like, "Oh, that would have never came up on literally any survey, an income statement, anything." So you can really hone in on those creative projects that move the needle. That it will help you on the retention and other expenses, but in the short term, you're like, "Oh, we never thought of that." So it's cool to really kind of see those creative projects get put together. Even here with the property I live at, we're adding a side parking because literally it's 3 levels and the third level has the least amount of parking. So you just get to really work on those creative pieces that make those raving fans stay longer.
Mm-hmm. Yeah, and I've heard, and this is something that's harder to do with third-party management, is just doing polls. It's just simply asking. Because, like you
No
said,
one likes to be as a former auditor. No one likes to see how if they're doing their job correctly or if they're doing it well.
Mm-hmm. Well, I mean, just like the amenities thing is, you might ask, hey, what would you, if you had a choice of these 5 things, what would you like to see? You might think it's going to be the pool if that was on the list, but you might get a different answer and you just never would have known. So you can make changes without asking and have them go nowhere fast, or you can actually ask the tenants first
That's why we have a tanning bed in one of our properties, and I'll never understand why. They picked
Wow.
the tanning bed.
That came from the tenants that they wanted
Mhm.
it,
Yep.
and it gets used. Okay.
I can't say that, but I think they've picked it, so I'm sure they're using it.
Huh.
It's just, I think with the pandemic, it's pumped the brakes, but
Right.
they picked it, they got it.
And I guess the only caveat to that is, you're asking a sample of tenants that you have for the immediate future. These are not going to be the same people that are necessarily going to be there 5 years. So your
Hope
poll is
so.
well, you hope so, but your poll is a snapshot of your current tenant base.
Yeah.
So it may not be the same desire for your future tenant base. So
Yeah.
whatever. I don't know how you mitigate that, but it's just a fact.
Hey, and that goes back to the stabilization. Like, you can get there, but you have to maintain in that excellence and constantly pull and figure out how to solve residents' problems every month.
Mhm. I don't want to keep going, Darren, if you got something you're chomping at the bit of.
No, I'm good.
You're part of an education platform, full disclosure, of which Darren and I are part of. So you talk to um, a lot of new investors, a lot of people just getting in, and this may be slanted more towards underwriting than operations because most new investors don't have property yet. You've talked to probably hundreds of people,
Sure.
dozens for sure.
Thousands of millions.
I mean, have you seen anything that just repeats itself and you're just like, oh, there's that thing again that, these new people are overlooking? And it's not out of, there's nothing wrong with ignorance. I don't mean that in a bad way. You don't know what you don't
It's
know.
being naive.
Yeah,
A naive
naive.
investor.
Yeah. I mean, if there was something that you could stop very quickly that happens over and over again, what would it be? Maybe there's 5 things.
There's a couple.
Maybe there's 50.
I'm going to say 3. So
Okay.
property taxes.
Yep.
Call the tax assessor. The first question I always ask is, how did you get this tax number? And everyone goes, you can call the property tax assessor.
It was on their T12, man.
Yeah. The OM is a marketing tool. And then there's 4 things. The OM is a marketing tool. Trust it, but verify every single number on it. So I don't even look at there for the T12, but it's a marketing packet. Property taxes, call the tax assessor. There's people who get paid to tell you how much it'll be. It's hard to navigate, but once you kind of get it, document it, so then you never have to look it up again. I think too, CapEx, I think it's just underestimating how much you should reserve in the sense of, well, it's a newer asset, I don't need that much money. Or if it's an older asset, I'm not getting as much money for it. So it can be very dangerous because if you don't have enough CapEx, you have to do a capital call, and then it just looks poorly on you. And it's just like once again, the operational death spiral. If I didn't raise enough money, there's all these problems. Residents are happy, they're turning in keys, and it just spirals out. So, and I think too is the naivety of, I'm comparing a 1960s asset with comparing apples to apples, right? A 1960s asset is not going to be even remotely close to the same valuation as a 2010 build, right? So I think it's just making sure when you're looking at your comps, it's apples to apples. Obviously, it's not, looking proximity, but also if it's similar size and units, number and the actual size, because down the street they're getting 1,200 and they're bigger, and you're a studio, 500 square foot efficiency unit, you can't get the same thing. So proximity to comps and unit size as well. So I think that's all I can think of right now, but those are like the big hitters of just making sure, trust but verify the OM, property taxes, call the assessor, have enough in your CapEx reserves. And if you don't know, talk to a lot of operators in your area, because every area is different, especially the Midwest is snowing even more than here versus in Tennessee. It might be different. Even in Carolinas, it's hotter. So it's just every area is different, and don't compare new with old and small with big.
Mhm. Yeah, and I'll pile on the property tax thing. It's also, and know the assessment schedule. Is it every 4 years? Is it every 2 years? I mean, if it's every year, if you're in Texas or maybe
Jacksonville.
Florida,
Yep.
that line item expense will probably have to be looked at all by itself outside of your 2% escalator, which everything else is doing. If you just float that one thing along without adjusting it for, I mean, if you're doing a huge rehab and really pumping the NOI up, they're going to grab that, and it's not going to be at that 3% or 2%.
I mean, look at Nashville's
Expense.
34%.
Well, yeah, I mean, I don't know yeah,
But that's what I mean is like, I think a lot of investors too is I'll be aggressive year one, and then like you said, 2% escalator. Well, if your taxes go up 40%, you're dead in the water, right? So it's just important to, obviously, Nashville, I don't think every municipality is going to go up 40% next year, but things that aren't going away, insurance, rising insurance expenses, making sure you're in a flood zone, like being very conservative and asking a ton of people what they think it is, because I kind of compare it to getting a quote with a contractor. You talk to 10 people, you're gonna have your outliers, but your middle 80% is gonna kind of be where the ballpark is.
yeah, and taxes and insurance are two of the big ones that you have very little control over.
Exactly.
Once they set that property assessment, you're kind of stuck with it. You can fight it and maybe you'll get it lowered, but maybe you won't.
Yeah. I mean, if you underwrite that tax number really high year one and it takes to year 4 to hit it, or even you fight it and it goes down, you look like a genius underwriter by being really conservative. And that's how much money you save your investors by just being conservative with that underwriting year one.
Mm-hmm. Okay. What's going to happen in 2021? Just like everything.
Me, you, and Darren are going to celebrate a lot of apartments that we buy individually together, and we're going to have a fun time doing it.
Okay. Yeah. All right. That's fine. I'll go along with that.
But I still think a more serious approach to the question. I think realistically, us being in the Southeast, I'm going to caveat it with just the Southeast. I think New York money will continue to pump in. I mean, we've seen on a lot of smaller deals. New York has been 1031ing. Even California has been putting money into Tennessee. So I think, I mean, we've had strong collections. So I think Tennessee as an entire state will continue to get hotter. I don't believe multifamily is just up forever, but I realistically seeing it as people are getting weary of the stock market. They want that the savvier investors are looking money to park it. And these capital groups and private equity groups had to sit on the sideline in the middle of the pandemic. So I think they're going to get more and more aggressive. And I see more and more funds starting. So I just think multifamily will continue to get hot. But I think what really will differentiate you or your listeners or anyone is execution. And that's where asset management is important because, yeah, it's great you got the ACK fee, but if you're going to have a bunch of pissed off investors that are upset and kind of, they're going to beat you up because you didn't execute. So it's just important to make sure you continue to execute with the highest integrity and ethical when it comes to making sure you're doing good deals and helping your residents every single day.
Yeah, well said. I mean, it's where the rubber hits the road is that property management and asset management, which is, like the NASCAR kind of thing. You're the guy up in the stand, your property management down there who's driving the apartment complex, and you're kind of being a spotter for it.
Because underwriting's the easiest part. Underwriting's the easiest part because you just look at an Excel and go, it should make this much money. But the day it doesn't, you'll have a lot of people let you know that it didn't.
Yeah. Yes, that's true.
Under promise all the time.
Yeah. It's tough being a curmudgeon.
I mean, but
my
that's the
deals
best. But that's like the best part is like, I mean, and I don't want to like scare operators and say, hey, make sure you're hitting a 20 IRR with no rent growth and 3% expenses and tax going up 40%. It's making sure the Ray Dalio of limiting your downside of what does it look like if this happens or if this happens? Because I even do it too of, all right, taxes go up 40%, no rent growth. Can we still cash flow? Is it worth it? Can I live with this? I can underwrite a deal and tell you why you shouldn't. And I know, Greg, we take pride in being the pessimistic realist. And so it's just important to making, I see the head nod, so I know it's true for those listening. But you have to kind of just you can't underwrite every scenario or a COVID, but it's making sure of, can it cash flow during a worst case scenario? And do I feel comfortable with that risk? Because everything, obviously, I think everyone has been riding the up, but can I live with the worst case scenario? And do I have an out just in case it hits? So,
Yep. Stress test.
Break it.
Yeah, try and break it. Yep. And that's what we do with the underwriting. We send it around. We're like, all right, here's what I've come up with. Tear it
and
apart.
you got a partner, Marshall Friedman, who does a good job. I showed him a deal and I got 2 pages of questions, and I was like, I didn't know I was writing a dissertation
That
on this
was the deal that
property.
we looked at too, though, if I remember right.
That is true.
Yeah. We were like, well, what
and the
about all
best
this
part
we thought of?
and the best part about it is we both looked together at the same deal, but it all came down to one particular lender that neither of us knew until like midway through looking at this deal. So it's just the different levers of real estate that you didn't even know you had and could find, and even partnering together. It's a learning experience for everyone.
Yeah, and that's another thing. Like if you do have somebody on your team or just somebody that you know that it's a pretty decent underwriter, it's really interesting to take a property and like just get an OM. Don't really discuss it at all. Just be like, you underwrite it. I'm also going to underwrite it. Let's talk when we're done. And it's very interesting to see how close they are. Or it's not that one's going to be necessarily right or wrong. Hopefully, you'll see stuff that you didn't think of, and then the other person will benefit from that as well. But it's a good exercise because it's the same thing with OMs and stuff. And I try to be pretty disciplined about it. I don't really read them except for the financial stuff that's in there, or hopefully it's an attachment in Excel or
It's a
something.
really nice picture book.
Right, exactly. I don't try and look like at the pictures and stuff like that because I don't want, try not to get emotionally charged or get some kind of subconscious bias because you're like, man, that's a really nice looking property. See if I can make it work.
Yeah. No, and even with us, uh, our analysts will look at something. I'll look at it totally different. Jake on our property management will tell me, the founder or one of our principals will tell me I'm being too conservative here, here, and here. So all 3 of us could look at a deal entirely different. Our analyst could be here, I could be here, and Jake could be like, and that's like the beauty of real estate is it's what you think the value is. And even then, I think too, like that's why I think I get frustrated when newer investors like people are overpaying when really it's just the cost of capital for these larger groups is so much lower. These bigger, larger institutions are looking to beat inflation, right? We, as our investing firm, we're looking for much higher returns than that. So when you get bigger, you're dealing with much bigger fish, and those fish are looking for smaller returns. So it's just making sure you understand where you are in this game of life. Don't get frustrated with it, but you might. I mean, before we were looking for 100 plus units. This year we've done a 52 unit and a 48 unit. So it's not like this is the bullseye we can only get. It's just kind of seeing what deals come by and what deals make sense to attack. So being fluid with it as
Yeah,
well.
I mean, I do the same way. It's like, well, what are you looking for? We're like, well,
A cash
It's
flowing
what we
asset that makes
like.
us money.
Yeah, but we'll look at what the market kind of gives us a little bit though too. That's a great point about the overpaying, and you hear that a lot, and I'm sure I've said it. Oh, they overpaid. And what I really mean is I would overpay if I paid that price. They're probably going, great, we're going to earn 5%, and
And I don't have to pay
our
taxes
group
this year.
is fine with that because that's what we told them that we were going after, and they're like, cool. You know?
And I always, I don't know if the listeners know, Greg Scully is on a coveted list with the Alex Rodriguez. So Greg is number 2. And if you take performance enhancing drugs out, Greg is number 1 in the Johnson City owners list. So
I love it.
like that investor who has A-Rod money, J-Lo money, all in one house has a little bit different return profile than Greg. So
a little bit.
Not much, just a little bit. But you found it first. You found Johnson City first.
Right. I think they own a couple of things around here.
Probably now they do.
That they overpaid for. Well, that's the thing is like, we can go on and on about pricing, but yeah, cap rates have come down. Interest rates are still low. Outside money is trying to get away from crappy commercial deals in Brooklyn or Manhattan that aren't.
Or negative interest rates worldwide are coming in.
So they're like, some people are just trying to hedge against losses elsewhere by getting some gains in something that's fairly stabilized and has proven to be fairly insulated from all this madness related to COVID. So yeah, there's definitely different needs being met out there for some people that, we haven't really seen in Tennessee that much. There's been outside money coming in, but I think it's going to increase, but we may also see, look at what VW is doing in Chattanooga. We may still see the other side of that where more industry will move here as well. So,
yeah, I think Tennessee, though, I think it's just people who don't like Florida will go to Tennessee. We're not in Atlanta by any means where Nashville's getting 4 or sub 4 caps. So I think there's still room. Nashville's still continuing to get hotter. Knoxville just sold an apartment for $190 a door. So I think overall I'm very positive on it, but it just as valuations rise, Howard Marks, your margin of error thins, and so it's just making sure that you're wary of that and aware and willing to accept that risk. So it just be careful, but I'm bullish. But when I say bullish, I mean like I said, we've acquired 100 units this year, and we've only been close on probably less than about a handful, and we haven't won. So it's bullish, but I think you just got to be careful in making sure you're hitting with a margin of error.
Mm-hmm. Right on. We'll start to wrap it up. I know Rand is great about systems. I'm curious, does Mikey T have any systems for himself? Routines that, just help you stay focused, help you execute, whether that be meditation, reading, or whatever, or going on hikes and singing songs.
I've been journaling more. It just helps document. I think when you people look at unit count and just like that progression and really take a ton of pride in that number. And when you're not doing deals a lot, it gets very frustrating. So I've been journaling a lot, just kind of like my weekly goals, my daily targets, highlights on the day, and just kind of like debrief and regroup. It's been really relaxing. I think the biggest thing was, exercise consistently. I realized this year I didn't do a physical challenge, so I suffered by not running. And so Darren and I are going to be doing the Ragnar, maybe like David Goggins style. We'll just do all 200 miles separate individually.
I'm in.
I think Greg's all about it too. Yeah, definitely.
I don't even know what it is, but I'm in.
Mike, Greg's a beast. In case you didn't know it,
it's a relay, right?
It's the relay. But we'll run it we'll each run 200 miles. We'll just race
in a row.
No.
But
No.
I think my when I'm at my mentally worst is when I haven't exercised or eaten well. I was almost 260 pounds, or if I probably was, and I just was in a very negative headspace, and I just let it compound. But once I started exercising consistently and eating right, that's what really helped me kind of game change my mentality. So consistent eating well, working out, and journaling, I think, are the kind of the three biggest things. And I have an asana too, but we won't talk. We'll say that for a different, for myself on everything I need to do with my life. So that's been a
You
game
use
changer.
Asana for your personal stuff?
Yep, my
Oh, wow.
workouts.
I've never heard of that.
I heard of I hired two VAs. So one of them's the accountant, and then I'm having another one kind of do some like. I had to research the median income for 100 properties we got from a list. And just kind of build a system, right? Because I listened to a podcast, Naval, I can't pronounce his last name, but he started Angel List. And his biggest thing is leverage, whether it be machine, so I'm learning coding, but also like human, right? So she is in, I think, Vietnam, and she helps with all my stuff at a smaller, lesser rate than if it were for me to do it. So it's just making sure. And even Neil Bawa says it of I can work 24 hours a day and get 8 hours of sleep. It's because I have people working for me or with me around the world. So I'm trying to build out that system to help me just kind of with my day-to-day life and just automate as much as possible or eliminate as much as possible.
Mm-hmm.
Very interesting. I appreciate that feedback right there.
Yeah.
Makes my head.
Don't spend time doing the things you hate. So I eliminated grocery shopping by getting Instacart. So for $100 a year, plus I'm sure an incremental, I never have to leave my house to get groceries, especially during the pandemic. And grocery shopping, I'm not claustrophobic, but I'll get claustrophobic just being like people watching me pick groceries. So I get to spend that extra hour hanging out with my girlfriend, reading a book, exercising instead of going to the grocery store.
Sure.
So
makes sense.
It's a cool piece.
Like it.
Yeah, right on. All right. Well, Darren, you got anything you want to?
No, I just appreciate the time.
All right.
No, appreciate the time. Appreciate insight on several topics that we covered, even though it was mainly asset management and the motivational stuff as well. We'll talk offline about your next adventure and what you need to get there with.
I gained weight during the pandemic, so Darren's gonna, kick my butt into running, moving, and shaking. And I challenge all the listeners to, build the system. Ray Dalio said it best of you are building the machine. You are not a cog in the machine. So it's important to own the outcome of what that machine does. So build the system around it, right? So for me, I'm going to show Darren my Asana of I got to run today 3 miles after this podcast when it's snowing. No excuses, right? Tomorrow. And so it's all automated. I don't have to think about what I have to do because that brain energy you're spending thinking about it, it's already gone and you just dial it in. So take ownership, build the machine to get to where you want to go, and kick butt and take names.
Here, I'll do a quick book plug. Mikey T wrote this book. It's called, oh no, you didn't write it. It shows up backwards, right?
Nope.
No.
Oh.
You're good.
Good strategy, bad strategy. I just cranked through this. It is probably one of the best.
I challenge you with this book.
Yeah, I know you like that one a lot.
No, I watched the video. I read the.
You can do it the 30-minute video as well.
I read the PDF thing too before it was a book. So in your face. But check out this one, Good Strategy, Bad Strategy, because it's a lot of it is about simplification and not confusing goals with strategy. That's probably a lot of times we talk about, hey, I want to own 1,000 units by the time I'm 55. Okay, that's a goal. That's not a strategy. So it's differentiating things that you want to do from how you want to do them. So it's pretty good. I highlighted the heck out of it. It's definitely on the read multiple times list. So you might enjoy that, Mikey T.
Well,
Darren, you'd probably enjoy it as well.
Because I think it's important too, because it's like I want to get that many units, but how do I get that many units? I have to call that brokers every day and talk to this many operators every day or off market every day. So it's that lead measure that you control, not the lag measure of number of units.
Yeah, and it's not real estate specific. It's just a business book. A lot of good case studies in there. So he lays it out on how companies did well or did not so well and are no longer with us. So, all right, let's wrap it up. Why don't you take us out, Darren? Putting it on.
Mike, we really appreciate the time tonight. Actually, one of our few podcasts we've done tonight. So, actually, hey, one more thing before we go. One of the most important things. How can the listeners get in touch with you?
Mike T at randcre.com is my email. Mike Taravella, Taravella on, I think LinkedIn would be the best way. Or just hit up Darren and Greg and they'll give you the direct line of communication.
Yeah, we can drop the digits for you if you need it. So yeah, great guy to talk to. Obviously not just about asset management, but underwriting, some other things. Really talented guy. And he's not just some boring CPA as most of them are. So he likes to call himself. So appreciate everyone joining us on this most recent episode with my co-host, Greg Scully. I'm Darren Light. Thanks for joining us on Real Wealth Solutions Podcast. See you, everybody.
See you, everyone.
See ya.